It's a great pleasure to host the Q4 FY19 earnings conference call of South Indian Bank. For the call, we are joined by Mr. V.G. Matthew, MD and CEO of the bank, Mr. Thomas Joseph, EVP Operations, Mr. G. Shivakumar, EVP Credit, Mr. K. N. Raghunathan, EVP Treasury, and Ms. Chitra, CFO. Now I hand over the call to Mr. Matthew, MD and CEO of South Indian Bank, for his opening remarks. Over to you, sir.
Thank you. A very good morning to all, and thank you for joining us for our Q4 FY19 earnings conference call. Before getting into operational and financial numbers for the quarter, I would like to highlight that our strategy to expand retail, MSME and agri business and increase the share of other income and improve our CASA is intact. Now, let me take you through key highlights of operational and financial performance for Q4 and FY19. As on March 31, 2019, total business for the bank stands at 1,44,056 crore, an increase of around 13.3% YOY. Advances grew by 15.5% YOY to 63,636 crore rupees, with growth drivers continuing to be MSME, mortgage loans, agricultural advances, and auto loans. Retail loans grew by 33.87%, SME grew by 16.23%, and agriculture by 9.52%. There was muted growth in corporate advances at about 4.88%. These growth figures clearly indicate the focus of expanding retail, MSME and agri loans portfolio. Over the last 4 years, bank has stayed away from various stressed sectors, and on account of this, bank today has nil exposure to sectors such as aviation, telecom, EPC contractors, etc. The exposure to discoms, steel and thermal power are very limited and are of good quality. With legacy problems of the large corporate sector under control and with strong growth in the retail and MSME sectors, we are on the threshold of a period of stable and risk-controlled growth and expansion. For FY20, we are targeting advances growth of 18 to 20%, where the focus will be again in retail, MSME and agri portfolio. On the deposits front, the increase was 11.7% YOY to 80,420 crores rupees. The CASA of the bank increased to 19,467 crore, registering a growth of 13.6%. CASA now stands at 24.21% of total deposits. The NRI deposits grew by 13.69% on YOY basis, and NRI deposits contributes 26.66% of the total deposits. Our investment book stood at 19,525 crore, of which STM contributed 15,452 crores and AFS 3,873 crores. Gross NPA stood at 4.92% as on 31st March 2019, vis-a-vis 4.88% for Q3, and net NPA stood at 3.45% vis-a-vis 3.54% for Q3. During the current quarter, a corporate NPA of 114 crore occurred because of the failure of the borrower, which is a Kerala-based medical college, to get approval renewed from the regulatory authority. In the current quarter, the non-corporate NPA is rupees 250 crore, despite a sharp spike in agri NPA of about 100 crores. By this, the cleanup of the large corporate book, which has been going on for the last 4 years, has come to an end. Going forward, we will in all likelihood be able to stick to the guidance of 250 crore accretion in NPA per quarter. Bank showed a strong recovery performance during the year and achieved the targeted level of 500 crore rupees, and going forward too, the recovery and upgrades will be at 500 crore rupees per annum. Net interest income for the quarter was stable at 499 crore rupees as compared to 492 crore rupees for the corresponding quarter last year. NII for FY19 as a whole was 2,020 crore as compared to 1,966 crore for FY18. Other income for the quarter stood at 236 crore as compared to 179 crore in Q4 FY19, registering a growth of 32%. Treasury could achieve a better profit during the Q4 as compared to that of last financial year. Further, our technology and transaction fee registered an all-time high of 120 crore. As we scale up our efforts on retail and MSME banking, we expect growth momentum to continue in the transaction fee business. Other income for the full year stood at 726 crore. Operating profit for the quarter was 328 crore as compared to 311 crore in the same quarter last year, with a growth of 5%. Operating profit for the whole year was 1,239 crore. Cost to income for Q4 FY19 was 55.44% and for FY19 as a whole was 54.88%. We believe going forward our cost to income ratio should come down as we get benefits of operating leverage from our centralized operations, higher fee income and treasury income getting normalized. Provisions other than tax for the quarter is 219 crore as compared to 149 crore in the same period last year. Provision coverage ratio improved to 42.46%. Provisions for the full year stood at 858 crore. Credit cost for the quarter stood at 122 basis points and for the full year it was 109 basis points, and we expect the credit cost to be in the range of 1 to 1.10% for FY20, considering the elevated provision requirements for the next few quarters. Bank's net profit for the quarter was reported at 71 crore, while for the full year it was 248 crore. The Board of Directors have recommended a final dividend of 0.25 rupees per equity share subject to approval of the shareholders at the forthcoming AGM. Our capital adequacy stands at 12.61% and the core CRAR is 9.97%. We recently raised 250 crore rupees in the form of Basel III compliant Tier 2 bonds. We would also like to highlight that many new data analytics initiatives have been taken for increasing our MSME and retail book by mining our existing liability customer base, and focused employees have been hired in the last financial year for growing this segment, which will all lead to overall growth of the advances in the retail and MSME sectors, which we believe are our core strengths. As on date, the total employee count stands at 7,822, and during the quarter, bank had opened 13 branches. We now have 870 branches, 53 extension counters, and 1,406 ATMs. 9 new branches were opened in Kerala and 4 were opened in South India, ex-Kerala. With this, we open the floor for questions, if any. Thank you.
Sir, can we begin with the question and answer session?
Yes.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Jai Mundra from BNK Securities. Please go ahead.
Yeah, hi sir, good morning and thanks for the opportunity. Sir, the couple of questions. First on asset quality. So this quarter, sir, we have seen the below BBB book has gone up from around 400 crores last quarter to around 1,000 crores plus in this quarter. So if you can explain, what is your sense on this portion of the book and any sectoral breakup here?
Yeah. In the double B and below, that is, we are talking about 100 crores and above. It is 0.8%, which is around 800 crores, 773 crores to be precise. Okay. Now, there are 4 accounts in that, and all of them are not even in SMA 0. All of them are standard. The largest among them is a multi-division company which belongs to a very strong, well-established group, and we expect, in fact, already there is another rating which is triple B, but we have taken the lower one. That is a rule, and I believe things will show remarkable improvement in the current financial year when the results are out. That's what I understand. Second one is the road project, which again has been taken over by a new group maybe a couple of years back, and again absolutely no SMA 0 issue even in this account. The third one is an airport based in Kerala, and absolutely no concerns on that. It has been commissioned and performing very well. Last one is a hotel project or involving 2-3 hotels belonging to a very well-established and well-recognized NBFC group in Kerala, and absolutely no concerns on any of these accounts.
Sure, sir. Thanks for the clarification. So these group, even though they are below triple B, you believe they should be sustaining their standard classification. Is that correct, sir?
Absolutely. That is, we have been watching these accounts all along, and there is not even SMA 0 status for any of these accounts, any of these 4 accounts.
Sure. And the first account that you mentioned, multi-division company, triple B, is it like conglomerate, infra to NBFC conglomerate, or?
No, it is not that. It is a very well-established group and based out of Kolkata and manufacturing, and it is very strong on that front. There is no concern about it.
Sure, sir. And sir, just one clarification also. Now we have seen that the number of accounts where the ticket size is more than 100 crores has come down to 300 something. So, and the total exposure is around 12,000 crores. So how does this tally? Each individual account has become less than 100 crores, right? That is the way to look at it.
I will be able to give you that separately, but I can only tell you this. I have absolutely no exposure to telecom, aviation, EPC contractor in the standard asset book. Absolutely no exposure to any of these accounts, these areas. I have only one major steel exposure, which is a company which belongs to a group which had no default history in its entire existence, and that's about all. And if we are talking about road projects, we have not taken a single road projects in the last 4 years. So we have stayed away from all these things. So we believe we have a very clean portfolio coming up there.
Sure, sir. And lastly, sir, if you can quantify the SMA 2, last quarter I believe it was around 1,890 crores. How has that moved?
Yeah, SMA 2 has moved quite well for us. So today it stands at 1.71%. It was 7.38% in 2016 March, 4.28% in March 2017, and 2.20% in March 2018. Today it stands at 1.71%.
1.17.
1.71%.
Sure, sir, sure. Okay, yeah. Thank you, sir. I will come back.
Fine.
Thanks.
Thank you. The next question is from the line of Chandra Govind from Ashmore Investment Advisors. Please go ahead. Sir, we would request you to please go ahead with your question. Mr. Govind?
Hello.
Yes, sir. Please go ahead with your question.
So my question was regarding the yield on advances. So when I compare last year MCLR rate and this year MCLR rate, there was almost an increase of 45 bips. But when I look at the yield on advances, there was no improvement over the year. So how one should look at this?
Yeah, that's a very important point. Of course, there are two aspects to it. One side is that the MCLR does not get fully repriced. All the changes don't get repriced immediately. That is one part of it. But there should have been slightly better, transmission of that during this period. But it has not happened for one primary reason, that is where the accounts are having significant amount of collateral security and a very good rating, which is the case with a lot of our accounts. We are not able to charge the kind of increase in the MCLR fully. We may have to compromise. So a part of it will be charged, a part will not be fully charged because in the spread portion it may come down. That is one side. Secondly, the growth is coming more on the MSM, the retail side of it. As you know, it is growing at 34% and that is 29% of the book. While the rest of it, is growing at a much smaller level. So these are the two things that would definitely impact that.
Okay, in that case, the NIM for the current quarter was 2.46. So there should be no improvement in that case.
So we are working on improvement for various things. For example, today we are in a position to talk about not having to write down interest on account of NPA. This has been a problem which we have been facing almost every quarter for the last 4 years. Some unexpected large NPAs would happen and significant interest write-down happens. That part is finished. That is one part of the story. That is the most important one, I would say. Secondly, we are really working very hard on the CASA side. The improvement has to happen. Thirdly, what we are trying to do, one more side that we have not talked about is what is happening on the liability side. We have been managing the gap between deposits and advances using purchase liabilities. Now, the purchase liabilities used to be comfortable because we were able to get it at cost sometimes lower than the retail deposits even. That was the trend until last year and even part of this year. Today the position is that, or at least the last 6 months the position is that the cost would have increased by almost 40 to 50 basis points on the purchase liabilities. That also has impacted. So all these things will get corrected and addressed differently as we go forward. That is what we are trying to do. We are focusing on the retail deposits. If the liquidity position improves in the market and again the pricing comes back on the liability side on the purchase liabilities, that is fine with us. Otherwise, we need to really ensure that the purchase liabilities are limited as much as possible. So we are working on all these things simultaneously. Plus, we are in a position to now look at credit at a slightly lesser level of collateral, etc., because the entire centralization of credit processing is completely over today. Right from agri to MSME to retail to corporate, everything is on centralized platform, and therefore today we have the highest level of control and comfort on onboarding, and therefore we can take assets which are not carrying the level of collateral that we used to insist on earlier. So these are all things which are going to help us in improving the NIM.
Okay. So in that case, what is the internal target for FY20 for the NIM?
Internal target is higher, but we should be looking at around, say, 15-20 basis points improvement during the year.
Okay. And one data keeping question. What was the actual number for SMA2 in terms of growth?
1,091. That is 46 accounts with 444 crores in the SMA2 5 crores and above. 46 accounts and 444 crores. And less than 5 crores, that is 0 to 5 crores is 3,264 accounts and 647 crores outstanding. Total 3,310 accounts with 1,091 crores outstandings.
So we don't have any SMA2 account in 100 and above?
No. we don't have anything at all. In the 100 crores and above, it is 0. 50 crores to 100 crores is also 0.
Okay.
And 25 to 50 crores, it is 2 accounts with 98 crore. And 5 to 25 crore is 44 accounts with 346 crores.
And my last question on agri slippages, was there any one-off or?
Yeah, it is, okay, one plantation is the only thing that I can say is slightly on a one-off side, but that is not the point. But more than that, it is, I think it is something about some expectations of debt waiver and things like that, because the interest servicing has to happen on 31st March typically, and therefore I believe some of them certainly did not meet that commitment, maybe fairly deliberately, expecting certain waivers. And so therefore the spiking is there, and even going by the trend during the last 1 month, we don't find any spike of this variety going forward.
Okay. Got it. Thank you.
Welcome.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to please rejoin the queue. The next question is from the line of Sapna Laha from Bajaj Holdings. Please go ahead.
Hello.
Please go ahead, ma'am.
Yeah. Sir, what is the equity raising plan in this year?
Equity raising plan. Yeah. This year we would require definitely additional funds. As you know, we have raised already some 250 crores of Tier 2 during the month of March. And of course, we have more approvals. We have more headroom to take even Tier 2 or even additional Tier 1 or QIP or any other option that is available to us. But we will need capital. Today, the CRAR stands at 12.61, but we have a clear growth plan of around 20%, so obviously we will need some more money.
Sir, and can you give me the details of that medical college which has slipped this quarter?
Yeah, it was, mentioned earlier also, maybe for the last 1 year we have been mentioning. This is a very good dental college first, which is running very well for the last several years. And then they also started a medical college, which is also running for the last 4 years. But then they are supposed to get yearly, regulatory approvals until the 5th year. So currently, they have not been able to get the renewal done, and we had there has been a concern about it for the last 1 year. So we had given them the final date as 31st March 2019. If they are able to show that, it is fine. Otherwise, we said we would be compelled to classify it as NPA because of the inherent risk. So we will see going forward whether they are able to get the license. But meanwhile, I believe there was 100% pass in the medical stream as well as in the dental stream.
Can you give us some exposure to stress companies, recent stress companies like Reliance?
Can you make it a little louder, please?
Sir, can you quantify some of this exposure to stress companies like Reliance, ADAG Group or something like that?
We have no exposure.
No exposure to Reliance?
No.
Okay. And for SL?
For?
SL
no.
Group?
No.
Okay, sir. Thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Sandeep Jain from Birla Sun Life Insurance. Please go ahead.
Yeah, thanks for taking question. Just continuing on the last question, on that medical group, how much we have exposure?
114 crores. The whole thing is only that.
And okay, so you are the sole lender, or it's a consortium account?
No, we are the sole lender. It is a long relationship. It was running very well, and we have got very large amount of primary security and also very large amount of collateral security by way of land right in the city of Trivandrum.
Okay.
So we have absolutely no concern on recovering the money. It is not like the syndicated debt problems that we have been encountering till now. And they are also looking at various solutions. Yeah.
So if I remove the 114 odd crores from your gross addition this quarter, so it's somewhere around 254 odd crores. In that, you are saying that the agri slippages is there somewhere around at what much?
100 crores.
How much? 100 crores. So it remains somewhere around 150 odd crores, right? But you are giving guidance for the next quarters or next 4 quarters, the quarterly guidance of slippages of somewhere around 250 odd crores, right? So what made you give that kind of guidance of 250 odd crores of slippages for the quarter coming or for the quarterly slippages if you are saying that 100 crores is agri and 114 odd crores is a one-time kind of?
Yeah. Are you hinting that it is on the higher side?
So that's what I am saying, that it is on the higher side if you are saying that 250 odd crores is also a one-time kind of, and if again you are giving a 250 crore kind of guidance for the slippages. So are you seeing any inherent weakness or some stress account which is coming kind of?
No, we are not seeing any inherent weakness. We are not seeing any major one-off or any of those things. But I think this is the indication that we had given earlier. We will see. Let us see what happens in the Q1, Q2, Q3. We would rather at the moment stick to 250 crores maximum slippage and a 500 crore minimum upgrade and recovery.
And from where this upgrade and recovery will come? Any lumpy account kind of thing?
So we have, now unlike earlier, now the kind of NPS now which are coming up, whether it is an agri or MSME or in the mid-corporate, they are all recoverable. Unlike syndicated debt or things like EPC contractors where we are not able to recover anything. Here it is not like that. And a lot of them are sole banking situation, and we are pretty sure about how to go about it, and a lot of work is going on. That is why we have been able to show the same. We had a target of 500 crores and we have achieved that. And the same thing will be happening going forward too.
Okay, thanks.
Thank you. The next question is from the line of Haresh Kapoor from IIFL. Please go ahead.
Hi sir, so just 2 questions. One is, if I just look at the average SME loan per account, that has gone up like 20% Q1Q. So, what's really happening there? Is it that, we are actually taking more exposure to the same person because they are in stress, or just because we want to become sole lender, or no one else is financing them? What is happening there?
Yeah. Is it about the ticket size?
Yeah, okay. It's on slide 12. So on slide 12, if you can just tell me.
Yeah, that's fine. Sorry, it was not very clear. That is why, there was some breaking the voice. Okay. So basically what we are saying is, our desire is to do MSME advances of slightly higher nature, higher value. Obviously, that's the way we are looking at it, definitely. And the average ticket size is certainly not on the higher side. We would like to see a reasonable improvement in the ticket size also. Of course, today what is happening is a large number of business loans are also getting sanctioned. That is less than 2 crore kind of loans. That is also getting sanctioned. But then we are also looking at, MSME loans which are maybe in the range of 10 to 15 crores if it is well collateralized, if it is a non-group, it's already dealing with us in deposit base. So we have no problem in entertaining those cases very well.
So what will be the average exposure that you're comfortable with? Any thoughts there, or is it pretty open in terms of?
We are very comfortable, taking exposures on 2 levels. As I mentioned, up to 2 crores business loans, which are basically on the basis of very parameterizable, numbers. So it is very easy. In those cases, we have absolutely no difficulty if the quality is coming up as a very superior one. The other one, we also have a portfolio of slightly larger MSME because we got about 200 branches which are what we call green channel branches, which are specifically meant for developing MSME and mid-corporate kind of business. So those branches, obviously, the talent level is much higher, the capability is much higher. Therefore, these branches can maintain better relationships and onboard slightly larger customers. So average ticket size will be more in the range of maybe this 40, 45, 50, that kind of thing, depending on how many numbers are coming up on both sides.
Okay, and how many of these clients will you be, as a percentage, be the sole lender? Let's say last year compared to this year, or anything?
Mostly sole lenders.
Okay. And second part is, if I just look at your service and traders kind of exposure, the retail breakup that you gave, that has also fallen on a Q-on-Q basis, and you have seen pretty strong growth on the gold portfolio. So for the gold side, is it more on the agri gold? And second, on the services and traders, why is it that you have seen a degrowth? Is there anything else there?
No, on the gold side, we are on, our around 16 to 17% is of the portfolio is collateralized with gold, that is when agri and MSME put together. If you look at it, around 17%, if I remember correctly, that is collateralized with gold. But as far as the other part is concerned, that is the pure gold, that is retail gold, we are very focused on that because this is a portfolio which has done very well for the bank. And we would like to see that, this is growing. And we have been trying to see that, there was a good traction in this. But last 1 or 2 years, we have not been able to, show significant growth. But the focus is very much there on that. And around 300 branches of the bank are typically placed in such areas where there is a lot of potential for such gold. So we believe that, these branches should definitely focus on this and improve our gold loan portfolio.
Okay, and the services and traders part that you have seen a decline, is there any reason you pulled back or what is happening there?
Not exactly a pullback as such because traders are important for us. But then one thing is very clear. The trade segment, we are very particular. Trade and what you call gold, wholesalers. We are very particular that they should maintain high amount of collateral security. For example, gold it is 100%. For traders also it is more like 50 to 100% kind of collateral security is what we are looking at. So only if it is meeting these criteria, we will be looking at those sanctions. And with the centralized onboarding, so obviously if the parameters are not met, it won't be sanctioned. So there will be a correction period that we expect. It will not be growing exactly in line with the past because it is on a centralized platform where the decisions are taken by a committee, totally away from the sanctioning branches and regions.
And just last thing on this, can you just talk about the geography or any other industry in particular where you are seeing, lower portfolios in your services and traders pool? Not really.
In fact, our portfolio growth is significantly in Kerala and Tamil Nadu. These areas we are doing quite well on that side. But otherwise, other areas it is more like MSME. But traders, yes, it is important for us subject to meeting the collateral security requirements.
Okay. And the last thing on this others portfolio also, there is some pretty strong growth. So what is the driver there?
That is the others. Yeah, that is, we have got institutions and all these, professional services and all those things. They are all getting clubbed in that is what I understand. That is, we have got, say, for example, if a school or all these things are coming up, it will get classified there. And even the personal loans will get classified under that. Yes.
Okay, sir. Thank you and good luck.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, sir. I have 3 questions. Firstly, like the agri slippage which you mentioned, an expectation of loan waivers that has happened, is this specific to any one state or you are seeing it across the states that you operate in?
We have only, primarily our agri business is Kerala and Tamil Nadu to a very limited extent in Karnataka. But otherwise it is primarily Kerala and Tamil Nadu. And initially we were thinking, there would be some problem coming out of the flood and things like that. But then we were very willing to offer flood relief schemes. The schemes were made available to whoever was willing to take that. In fact, we had made a very special drive for that. But some people have not taken it, saying that, they would definitely be repaying on time the interest and servicing would be met. But in the final position is that they have not met.
Okay. So these agri slippages are coming in equally from Tamil Nadu and Kerala?
It is almost across the geographies. We are primarily in the South India geography, and I think there is not much of a difference that we find.
Okay. And so secondly, this quarter we have added more branches than we typically have added in past many quarters. So what is the outlook there and which region do we plan to expand in terms of branches further?
Yeah, some of them, around 9 branches are in Kerala and the others are in in South India, but typically Andhra, and that is one geography where we are very keen on growing, because we got a lot of branches in the Telangana region, but in the Andhra region we don't have branches, and we believe that is a very important region for us. And similarly, going forward, the growth will be, as we were always mentioning, wherever the clusters exist where we have larger potential, like we find, for example, Ludhiana, we are very happy about our branch presence. Like that, in some of the very well-known industrial centers, we would like to have a greater presence.
Okay. And lastly, sir, when we guide on like the credit cost for FY20, so what sort of provisioning coverage are we looking to achieve on our ILFS exposure?
ILFS, we have around 15% provision at the moment. We are still not very clear exactly how it is going to move, because we don't have any full clarity about it. But then we would definitely like to take a higher level of provision there. We will do that as we go along.
Okay. Thank you so much, sir.
Welcome.
Thank you. The next question is from the line of Tanubhav Vashisht from Sher Khan. Please go ahead.
Good morning, everyone. Thank you for taking my question. My first question was just to finalize the point we were talking about net interest margin. So you said you're looking internally for an improvement of 15 to 20 basis points. So that is from the current quarter of 2.46%, or is it from 2.65%?
Yeah, in fact, it was always from the 2.65%. You are absolutely right about it. 2.65 plus 15 is 2.80 is what we were looking at. But that is why I said internal targets are a little different. While today I am only talking about a 15 basis points from where we stand. That is a conservative way of looking at it, but definitely that is not the internal target. What you said is right.
All right, understood. And secondly, my question was, while I was going through the segment profitability, I saw that retail banking segment took quite a hit from 109 crores in December 18 quarter to around only 73 crores in this quarter. Any specific reason for this fall?
Can you explain that once again? Just the second part of it, I just missed. Yeah.
Going through the segment results provided by the company. So in the retail banking segment, the profitability from around 109 crores in December 18 quarter has come down to 73 crores, which is a significant fall, and that has impacted the overall profitability too. So any specific reason why the retail banking segment has done poorly this time around?
No, the retail banking segment has not done poorly at all. It has grown quite well. We will give you separately.
Okay.
Agri slippage, I believe, is the one contributing to it, but we will come back to you and give you separately, because that one is done differently. We'll do that. We'll come to you separately on that.
All right. Okay. Thank you. That's all from my side. Thank you.
Thank you. The next question is from the line of Amit Rane from Quantum Securities. Please go ahead.
Hello. Yeah, thank you for the opportunity. Sir, I just want one data point. What's the average cost of the Tier 2 bonds that we have raised recently?
11.75% semi-annual. 11.7% semi-annual.
Okay. And sir, can you share your outlook on ROEs for next 2 years?
I would rather talk about the ROA part. Leverage, of course, as you know, is pretty good, for us. So it is a derived number, ROE. So, I would rather talk about the ROA. Now, the ROA is pretty low today because of the very large amount of credit loss that we have to provide for. That is what is happening today. Now, I do not expect a significant improvement in the provisioning going forward too. I am very confident of the slippage part, but I am not confident of the exact nature of provisioning that is required going forward. Of course, I am very well aware of the fact that, we have only 42.46% of provision coverage ratio. We should move to at least 60% plus at the earliest. So obviously, that is the reason why we have been talking about, credit provisioning of something like 200 crores every quarter. So that is a number that is going to happen. Therefore, it will be around 1 to 1.1% credit cost depending upon the advances level, average advances level. So that is what it is.
Sure, sir. Thanks a lot.
Welcome.
Thank you. The next question is from the line of Pranav Gupta from Birla Sun Life Insurance. Please go ahead.
Yeah, my question has been answered. Thank you.
Thank you. The next question is from the line of Dr. Alan Baby from Gems Wealth. Please go ahead.
Hello, sir. Good morning. Thank you for the opportunity. So I actually got two questions. One question has been partially answered. So it's in line with the broad analysis, why our profitability has been low, despite growth in the business, is because of primarily on the pricing of a book. That actually doesn't translate to the income. Another reason is high elevated cost to income structure. So when I see your presentation, I think 47% has become 55%. So can you lead us through that? Yes.
There are, when it comes to cost income ratio, typically, it used to be an income side issue and not on the cost side, because finally the income get affected by the treasury performance. This is what happens typically. Like, unfortunately, last 1 year, if you look at it, barring this quarter, we have not been able to do very well on the treasury side because of the relatively flat market position. So that alone will take care of the cost-income ratio. That 47% to 54% is substantially because of that. Having said that, I must also admit the fact that the cost structure also has increased a little bit because the employee cost has gone up disproportionately, I would say slightly, because of the gratuity incidents and also the DA and all those things, and also the need to top up the pension fund even more. So with all these things, the overall staff cost is also on the higher side. So these are, and staff cost is one of the, is the largest cost for us. So obviously, these are the numbers which have impacted the cost-income ratio. And with a steady performance from the treasury and even a normal returns in the normal NIM environment, we should be able to achieve a cost-income ratio which is around 50 or even slightly less than that.
Okay. Thank you for that. And so on the primary part, do we have any structural pricing issue with the book? So, it's probably a large chunk of fixed rate assets or something like that.
That is not there, but it is all about. I told you there are. Structurally, if it is there, yes, I would say that one or two small things are there. That is the retail loans. We want to work on the strong belief that we want to be a retail banking powerhouse. When we embarked on that mission, we were quite aware of the fact that the high-quality retail assets will obviously be NIM negative, and therefore the liability side, CASA side, has to improve simultaneously. This is what we were working on. That was the plank on which the whole structure was built. The fact remains that CASA has been growing and growing better than the deposits, and CASA ratio has improved from sub 20 to 24 plus today, and it may improve to around 25 during the course of the year. That's what we are looking at. But if you look at the CASA growth, it is around, say, 13-14%, while the retail loans are growing at, say, 34%. And retail loans are no longer a small number. It is at 29% of the book. So obviously, some more improvement has to happen on the CASA side. That is one side. Secondly, it is not about the structural, part of the loan book, but it is more about a mindset. For example, we are extremely cautious on the risk side today for two reasons. One is we are just coming out of the biggest problem that we were facing all along, that is the large corporate NPA, and we have cleaned up that book, and we can also see from the SMA2 numbers and things like that, we are or even rating numbers that we are really on a strong footing on that side. But then we are extremely careful that the MSME, the agri, the retail, that book should remain just as high quality as it used to be earlier. So therefore, there is always an orientation towards higher collateral security, etc., which immediately impacts on the pricing. This is what is happening. So now that we are on a completely centralized platform, now that we are quite well controlled on the risk side, and we have a lot of analytics information coming in every day, and there are vertical heads who are supposed to follow up each one of these things, and we have a very strong credit monitoring and recovery department, and also a credit collection hub which is running very effectively. We believe that we can start being a little bit more aggressive on the underwriting side, and therefore we can look at a slightly better pricing. This is what we are working on.
Thank you so much, sir, for the very detailed answer. I think it would rather help every investor to know these 2 points. Thank you so much.
Thank you.
Thank you. The next question is from the line of Saurabh Tole from Trivantage Capital. Please go ahead.
Yeah, so thank you so much. Just a couple of questions. On slide number 45, the active debit cards have fallen sequentially from 4.3 to 3.8. Why would that be?
this quarter was
4.3 million to 3.8 million.
Yeah, agree. Just a moment, please.
Yeah.
See, this year, at the end of the year, we have been doing a lot of replacement of old magnetic cards to EMV chip cards. So what happened there is many old customers who are not using this card for quite some time. We have not given them substitute cards unless they ask for that. So there is a gap now. So we are waiting for the request, and maybe over a period of time it will gradually increase now. The gap, the dip has come because of that.
Okay. And on your number of employees, showing a sequential fall, as in there was a reduction in the total number of employees during the quarter. Is it primarily because of retirements?
It is, yeah, it's a slight mismatch. New people will be joining very shortly. Some batches already running in an institute where, the probationers are completing their training. And when they all get onboarded, they are still on a different platform. When they come and get onboarded, then that also will get corrected.
Okay. Again, just coming back to the corporate slippage, that educational institution loan that slipped during the quarter, how well are we covered there?
We are extremely well covered because the primary security itself will be more than twice the loan amount. Plus, we have, because it is a medical college and a dental college. The dental college, we are not even financing.
Land banks?
Pardon me? No, we have got, the institutions, properties, everything, including the land, building, the machinery, everything is available to us. That is one side of it. Apart from that, we have got primary security in Trivandrum city. We have got collateral security by way of land and, completely free vacant land, sizable vacant land right in the city of Trivandrum, which is also very close to the value of the loan itself on a very conservative basis.
So all securities, if you include, you have a cover of 2 times?
More than 2 times.
More than 2 times. Okay. But, of late we've seen some of the banks who, had land banks recovered from, say, some of the builders. The RBI asked them to devalue those on their books and bring it down to zero over a course of, say, 3-4 quarters. But do you think you would also have to do this once you get charged or once you get possession of this land bank? Because
we don't think so. We don't think so. In fact, we have also been encouraging him of late to dispose of this land and square up the loan straight, which he can do. But I think they are also hoping that they would be getting the license to continue. That is number one. Number two, I think there are some people who are interested in joining him, and taking over the college. So these discussions are going on at the moment. We are not looking at a loss scenario at all here.
Okay. And just one last question. I don't know if you already discussed this, but there has been a very sudden rise in the gold loan book in the last 1 year, especially in the last in Q3 and Q4, sharp surge in gold loan. So any reason for that?
Yeah, there was also a purchase of gold loan because when the NBFCs were facing liquidity issues, they were willing to sell it at a price which was acceptable to us. So we have taken a certain purchase portfolio as we have mentioned in the last quarter. That is the only change.
And how big was that book?
I can mention that just a moment. I think that is the entire purchase portfolio, all told, not only just gold, all told it is around 1,000 crores today.
And this is just one NBFC?
No, it is not one NBFC. No. These are from people who are very well known to us and where we are very sure about the portfolio that we have purchased. It was 1,300 crores total. I am not only talking about gold, it was also gold plus small amount of LAP and housing loan. That's about all. Yeah. But that is today only 1,000 crores. 300 crores is already repaid.
Okay. Basically gold plus LAP, all this amounts to about 1,000 crores.
1,000 crores today, yes.
Okay.
Yeah.
Thank you so much, sir.
Welcome.
Thank you. The next question is from the line of Vinayak Kanvinde from Silver Arc Capital. Please go ahead.
Yeah, hi. I have two questions. One is on, if you could throw some light, you've already talked about it earlier, on the SMA2 advances. I just wanted to understand what is the overall percentage of these advances as a percentage of the total advances that you have?
Which is 1.71. Yeah.
And how has this trend been for the last 8 quarters?
I will just read out one moment. Yeah. Yeah, our SMA2 portfolio was 5.95% on 31/3/2015. It was 7.38% in March 2016. It became 4.28% in March 17 and became 2.20% in March 18, and now it has come down to 1.71%.
And as a breakup, this largely pertains now to which segment? Is it all MSME predominantly or agri predominantly?
Let me see if I have a breakup. It is one thing I can tell you is, I can give you one breakup that is above 100 crores. For example, the large corporate loans, it is 0. 50 to 100 crores also it is 0. 25 to 50 crores, there are only 2 accounts with a balance of 98 crores. 5 to 25 crores, which is what you call the typical, MSME plus the mid-corporate.
Right.
That is, there are only 44 accounts with a balance of 346 crores. Now, less than 5 crores. That is where, the larger distributed numbers are coming. That is 3,264 accounts covering 647 crores.
Okay. Okay, that answers. One more follow-up question with respect to, you touched upon this a while earlier in terms of return on assets. If you look at the trend of return on assets from 2017, which was the strongest at around 0.7, now this quarter we are down to about 0.3 plus, between 0.3 and 0.4. On an yearly basis, we are in the range of 0.43, 0.45%. How long would it be before you reach respectable numbers of 0.75 to anywhere close to 1% on the return on assets?
Yeah, it all depends only on one number. As far as operating profit is concerned, it will consistently improve. We have no doubt about it. And, that has been the trend, barring this year when the treasury contribution came down significantly. But we believe it is a one-off kind of a situation. Treasury also will come back to a normal contribution of around 250 crores to the annual balance sheet. This has been the case earlier, and it will come back to that. Once it does, as far as operating profit is concerned, there will be a decent growth at all times. What we are not able to help is the provisioning part. So provisioning is coming to, there was a time when the provision was, total loan loss provision used to be just about, 100 crores, 120 crores. Even in 2011-12, that was a position. Today we are talking about 1,000 crores. And that is where the difference is coming. So if you, just assume that this heavy provisioning has to continue for a few more quarters until the provision coverage ratio improves to something like 60%, then the ROA is a given. It will just start improving. Even today, if you remove the provision, automatically the ROA improves.
Right. But then it's a chicken and egg because the provisions just keep happening. So my question is, therefore, are we above the hump in terms of, having the provisions? Because your run rate continues to maintain in the 250 is what you're guiding for, right? The provisions for FY20 as well.
That is, you are talking about the NPA. That is, NPAs will come even at 250, and with the kind of recoveries which are coming in, we are talking about a 500 crore NPA accretion in a year, while it was much more than 1,000 crores every year in the past. We are talking about 1,600 crores in 2016, 1,700 crores in 2017, 1,800 crores in 2018. This is the kind of number that has been coming in. It will all go down now going forward. So the profit part is over. So therefore, the recognition is over. Now what is not over is about the provisioning part. So that will have to continue for a very short period. Now, that anyway, we have almost reached the end of it.
Okay. Okay, just one last question, if I may squeeze. On the slide 21, this is just maybe a housekeeping question. You have less than 5 crores to more than 100 crores breakup given on number and value. The average on each category comes much lower than the advances number. So, does that imply that most of these are 2 or 3 or 4 year vintages, which therefore are skewing the average number? Is that a fair thing to say?
Please give us a moment, just a moment. Yeah. Could you explain the last part of the question? We are on the slide 21. Yeah.
Yes. So basically, if I look at more than 100 crores on the 12,000 crore advances, basically 314 accounts you have. So on an average, this is much lower. It's like 15 crores, 18 crores probably is the average. Just wanted to ask whether because these advances were given 1, 2, 3 years ago, and therefore they have fallen off, and therefore the average is lower. Is that how it works? Because the same case is the case of 2,500 crores and 525 crores as well.
Yes.
So that was the first question. Second question, if I may ask on the same slide, is there was a sharp decrease in the number of accounts between December and March from 381. I'm talking about the more than 100 crores from 381 to 314.
Yeah. Yeah, that is true. One of the things that we are doing. What we are doing is, the only portfolio which has been giving us some trouble seriously was the 100 crores and above portfolio. There has been a very sustained effort at bringing down the individual exposures. Now, right. I am not exactly saying that, this is the average ticket size is exactly correct. That I will not comment on that at the moment. All what I can tell you is the top accounts, if you see there, we had exposures as big as 300, 400 crores in certain cases, or slightly more than that in some cases, where we have been able to bring it down to more than 50% of that, or maybe closer to 150 crores today. So there is a sustained effort that has been going on in terms of reducing the exposure in these accounts. That is there. That is going on very regularly, and that is also helping us quite a lot. And the more important thing is, what you can see is that over the last year, and also if you take several years back also, this portfolio has not been growing significantly. In fact, actually, there are repayments coming in. We are just about filling in that portion, maybe diversifying into another account in the same sector, that kind of thing. But otherwise, we are not giving money to the same people quite a lot. That's what we have been trying to do in that sector. Number-wise, we will once again check and tell you the exact position.
Sure. Yeah, thanks. No more questions.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. And my apologies in advance for some of the comments and questions that I'm going to make. It's more, my frustration on misplaced faith in the management and assessment of the management performance. You've been talking of your performance. Now, the first thing is your pre-provision operating profit has fallen from 1,480 crore to 1,240 crore this year, which is, irrespective of NPA, 250 crore fall is quite a lot. You have the lowest ROA in spite of no real NPA problems now. Okay, and therefore you're not talking of ROA target. 2 years ago, you had said that you will do 1% plus ROA. Your NIM is lowest at 2.4% amongst all private banks. And you have the lowest CASA and lowest lending yields. You borrowed Tier 2 capital at 11.75% and you are lending at 9%. I really don't know what's your plan to improve the functioning of the bank. Thank you.
So to come to the first point, that is operating profit. Operating profit between the 2 years, the difference is 242 crores precisely. Now, the explanation is Treasury, which had 180 crores last year, has contributed 120 crores this year. There is a decline of 60 crores. We had a sell-off of priority sector lending loans, that is about 89 crores income we could get last year. We were definitely looking at, we have even now priority sector loans to sell, but the market is not available for that. Therefore, it has come down to 32 crores. There is a decline of 57 crores in that. Other one-offs were around 86 crores last year. This year, it is only 25 crores. There is a difference of 61 crores. So on the income side, there is a decline of 178 crores. And on the staff cost, there is an increase of 108 crores around, some of which is, as I mentioned some time back, slightly on the higher side, and because of the incidence of higher gratuity, filling up of some of the pension funds because of the interest rate difference. So the total divergence can be easily explained by these two numbers. Now, on each one of them, we are seeing an improvement and we are working on it. Treasury this year is definitely expected to do much better than last year because the interest rate scenario is definitely more positive for Treasury part of it. Priority sector lending certificate is an opportunity available. I mean, we are ready for that, but then it all depends on the market. We are not sure about it. But instead of that, at least on the income side, we are expecting significant gains to come from the insurance, for which we have done many tie-ups, and all those things are giving a better traction on the ground. We have done that in the last 1 year, and there is definitely improvement on the life side. It is giving us improvement there. Our technology and other technology-based products are giving us higher income that we have mentioned. And similarly, we are also expecting some interest on the IT refunds during this year. As far as the staff cost is concerned, we believe, this kind of one-offs are not coming in. Therefore, we believe that the operating profit will continue to increase in a normal manner. That is the first part of it. Now, the second part, as far as the ROA is concerned.
Hello.
Yeah.
Can I interrupt here?
Yeah, please.
None of the other banks have seen a fall in operating profit. Yours is the only bank which has seen a 20% fall in operating profit, and you're trying to justify it with all these reasons.
No, we are giving you the explanation of what happened.
You can give explanation, but the fact is, I have figures of all the banks in front of me, and nowhere I have seen a 20% fall in pre-provision operating profit. We're not even talking of the NPAs or the provisioning part. So at the operating level itself, the performance is down by 20%, which is, really difficult to justify, whatever means you want to say.
So we are mentioning...
And this is in spite of the growth in the balance sheet, Your balance sheet has grown from deposits have grown from 72,000 crore to 80,000 crore. In spite of that, the PPOP has fallen by 20%.
Yeah, that's what I mentioned. The PPOP has been impacted only by certain things which are one-off related to this year, and we do not...
Yeah, but sir, you have to appreciate that 20% is a huge fall, It's not even flat. It's actually a degrowth.
Correct. We appreciate that. That is one of the reasons why we mentioned that at the outset itself. It is there, and we are also explaining why it is so, and why we are expecting that the position will improve going forward.
Okay.
Thank you. A reminder to all the participants, we would be taking up the last 5 questions. And in order to ensure that management is able to address all the questions in the queue, which would be the last 5, we would request the next 5 participants to limit their questions to 1 per participant. The next question is from the line of Haresh Kapoor from IIFL. Please go ahead.
So last thing from my end, I think just on the margin side, if you could just give some color how we are in terms of FY20. We have been kind of targeting a higher number than what we have been putting. So what is the expectation there for FY20?
On the NIM, as we mentioned, we are working on 3-4 areas. One, of course, is even on the pure credit side, whether now that we are having a fully centralized platform and we are fully on a committee-based approach, whether we can take slightly less collateralized kind of loans as compared to what we have been doing today. For example, as we mentioned, in the case of many areas, many of the traders and segments like that, we are insisting on 100% collateral security. So, instead of that, we may be looking at a lower value going forward. That is one side. And we have the capacity to manage that kind of a portfolio because of the centralization that is available for the entire underwriting, one side. Second, because of the collection hub which is functional, the recovery and monitoring department which is able to now reach out to many of the customers very easily. So we are in a position to look at this in a slightly more relaxed manner as unlike what we have been doing earlier. That is one side. Second side, as we said, on the liability side, it is important that we do not depend on the purchase liabilities to the extent that we have depended upon this year. And that alone has created a 50 basis points change as far as the purchase liabilities are concerned. So that we are trying to reduce by going in for more retail loans. That is one. Thirdly, the CASA ratio we are trying to improve. CASA growth is even today at a reasonably respectable rate of 14%. We are trying to improve that also. So with these things, definitely we expect there will be improvement in the margin. The other side is that, which is a benefit that is likely to accrue to us, that is the large NPAs which were coming up earlier, which impacted the interest by way of write-downs, will not be there going forward.
So just after doing this math that you just mentioned on these variables, what would be the range that FY20 would shape up like?
So we are looking at least a 15 to 20 basis points improvement.
From the closing number of 2.4? From which number are you looking at 15 basis change?
Yeah, today in any case, because it is not very correct to talk about 2.65, so we should be talking about 2.5 and maybe another 15 basis points. Therefore, we are talking about 2.65.
2.65 for the entire year, that is FY20.
Yeah, that is what we are looking at.
Okay, fine. Thank you, sir. Good luck.
Thank you.
Thank you. The next question is from the line of Pranav Gupta from Birla Sun Life Insurance. Please go ahead.
Yeah, just a clarification. You said you borrowed Tier 2 bonds at 11.75, right? Hello?
Yeah, our borrowing is 5% for the Tier 2 bonds.
Tier 2 at 11.75 semi-annually.
Correct. Yeah.
Right. Yeah, thank you.
It is Tier 2 bonds, basically compliant Tier 2 bonds, not for funding the liabilities. Okay. It is for basically for shoring up capital.
Yeah, capital, right. All right.
Yeah.
Thank you. I hope your question is answered, Mr. Gupta.
Yeah.
Thank you. The next question is from the line of C.G. Philip from Axis Securities. Please go ahead.
Yeah, good morning, sir. I have this question on the kind of retail loan book growth that we could see in the next couple of years, and it will be driven by which particular segments?
Yeah, the retail growth will continue to be more than 30%. Retail will grow at more than 30%. Pure retail, which is 29% of the book today, it will grow at more than 30%. MSME will grow at around 20%, and Agri will go at around 15 to 20%. Because the last to centralize was Agri, and therefore we are expecting there will be some more lag before the full swing comes in. So the targeted growth rate otherwise is around 20%. So Agri, which is around 14% of the book, will grow at around 15 to 20%. And the mid-corporate, that is 25 to 100 crores, that also will grow at around 20%. While the top, syndicated debt, etc., there may not be any growth at all. In fact, there could be repayments.
Okay, thank you, sir.
Thank you.
Thank you. The next question is from the line of Sneha Ganantra from Shubhkam Ventures. Please go ahead.
On the outstanding security receipt and how much provision we have provided as of now, or any further provision we need to provide?
Yeah, SRs are 1,285 in terms of book value. Provisions are 279 crores. And net asset value, therefore, is 1,006 crores. We had a incidence of high provision of around 250 crore on one particular tranche, what we sold out in March 2017. 1,776 crores which is sold out in 2017. We had a incidence of higher provision in September 2017. Now we are not sure. It is already carrying more than 50% provision. More than 50% provision is available on that portfolio. But still, because there are certain IBC accounts in that, and where the resolution pattern is not fully clear to us, what exactly would be the position on that, we are not clear at the moment. The worst case scenario is the incidence of provision on that.
So how much we have to going for, we are planning to provide also for the safety side?
No, we have to provide for the entire one if there is an incidence. But we are very keenly watching. We are reviewing that portfolio. We are also, trying to understand from the rating agencies who are evaluated, how they look at it. And we will accordingly make provision. There is no other way. Whatever provision is there, that is what we have made in 2017 September. We will do that if it is required.
Okay, got it. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would like to hand the conference over to Mr. V.A. Matthew for closing comments.
Thank you very much, and thank you very much for your active participation. We hope we have explained the position clearly. In case there are any further clarifications that is required, please contact us, specifically the CFO or DGM Investment Relations. Thank you.
Thank you. Ladies